Hi, the budget has come and gone, but is this rally going to sustain? I'm sure this is a top of the mind recall question that all traders, or at least almost all traders, must be experiencing as of now. You see, the budget was very unique in the sense that no taxes, levies, increase in long-term capital gains that the market was fearing were imposed, which is why a relief rally had to come. But the relief rally, that is the moot point. So at what point in time does the bear covering which you saw starting from the day of the budget itself, and I'm going to explain to you as we progress in this video with the help of graphics, as to how it was bear covering coupled with a little bit of buying, of course, that resulted in sudden huge spikes in the markets that you saw last week. And is there a probability of profit taking starting to come in? Because remember, even the bulls do not make money unless they lock in their profits and take the money home. Friends, in this video, I'm going to try and help you come to a conclusion, or at least come to a probable conclusion as to where the markets are likely to head in the coming week. I'm Vijay Bambwani, a trader with 35 years of trading experience, 28 of which are as a CEO, founder, promoter of an incorporated limited company that trades for a living. And I'm going to help you become better traders through my YouTube channel. So let's dive right in. As I said, the rally was primarily fueled by no new taxes coming in or no new COVID levies being imposed in the markets. Now, the upward targets that I had given both for the Nifty and the Bank Nifty were surpassed. This is something that I told you in my video last week itself, that the budget might just raise the element of volatility and therefore the targets might be breached, which is something that happened. The Bank Nifty continued to outperform the Nifty due to the disinvestment announcement by the Honorable Finance Minister, and the Nifty also rallied, but the Nifty is, remember, a constitution of 50 stocks, whereas the Bank Nifty is far narrower, being made up of 12 stocks only. As you can see on your screen, the market roundup, we saw bullion which fell because risk on sentiments, which is higher risk appetite for financial instruments, was seen in the markets. So traders typically preferred to go long in equity shares, and bullion, which is a safe haven, saw selling. We also saw crude oil and natural gas, which rallied, which is of course a negative that the markets have completely shrugged off. And the second thing that the market has shrugged off, at least the Bank Nifty along with the banking stocks, it shrugged off is the steep jump of 19 basis points in the 10-year benchmark bond yield. I'll come to this when we reach the bond section. The Dixie rallied 0.5%, but the USD INR fell, which says that the Indian currency gained strength against the US dollar, which is a positive, because I've been telling you in my recent videos as to how emerging markets, including India, want a strong local currency because we are import dependent, and therefore, in spite of the fact that the US dollar rose against other currencies, it fell against the Indian rupee. Now, coming up on your screen is the market-wide position limits chart, the MWPL chart. And remember, the MWPL is a figure that I put out on my social media pages every evening. So maybe it'll help you connect with me on any of my social media accounts. My contact coordinates will come at the end of this video. And you can see in real time as to how MWPL changes day on day. So the chart basically tells you that a steady build-up of MWPL because of fresh exposure being created by traders on hopes of further rallies in the market. And of course, once a new derivative series is open for trade, traders do gradually tend to raise the exposure levels. Now the volume levels are a revelation. The volume chart on your screen shows a steep spike on budget day, which is but natural because shorts were covered, fresh long positions both on intraday and rollover long positions were created, which is why the volume jumped absolutely. But unfortunately thereafter, and the markets have risen all 5 days of the week, volumes on the contrary, instead of rising on these bullish days, has actually started easing, which is something that is rankling me a little bit. And we'll also see that in greater detail in the chart section of the Nifty and the Bank Nifty. Now, that the rally has been fueled by short covering is something that I told you, which is why the volumes spiked absolutely on the 1st of February, and thereafter it's been basically coming down. Take a look at the basis chart on your screen right now. Now, the basis is nothing but the premium of the futures as compared to the spot prices. Now, the basis has come down on a week-on-week basis, which tells me that once the shorts have been squeezed out, there is very little short position left, a residual short position from the earlier pre-budget positions left, and therefore the premium has contracted. It has also contracted because on Thursday and Friday I witnessed fresh short positions at higher levels also being created, which is why the basis has compressed significantly, and therefore in spite of the fact that it's the second week of the new derivative cycle, or rather 1 week completed of the new derivative cycle, the premium has actually shrunk abysmally. Friends, the roundup done, let's now take a look at the 10-year benchmark bond yield chart on your screen. Now, what immediately struck me in the budget was the Honorable Finance Minister announcing fresh borrowings by the Government of India from the bond market to the extent of 12 lakh crores, which immediately triggered off a selling spree in the Indian bond market, because bankers were anticipating that these fresh bond issues would be at a higher coupon rate, which means interest rate, and therefore they are dumping older series bonds with a perceived lower coupon rate. Now, the problem with this is that the biggest holders of these bonds are the banks, both private and public sector banks, more so in the case of public sector banks. Now, when they are dumping bonds, the prices of these bonds fall, therefore the yields rise, but there is a mark-to-market loss on the existing portfolio of the benchmark bonds that they are holding. So the Bank Nifty has shrugged off these concerns. The banking stocks have shrugged off these concerns of mark-to-market losses on the bond portfolio and have risen. This is another reason why I feel that there might be a corrective decline in the markets in the coming week when the markets realize all these factors by themselves. My viewers who are seeking to deploy funds in debt instruments, especially liquid funds, will get ample opportunities in the coming months to deploy funds, because at some point in time the bond yields will basically top out, and you will not have the threat of your NAV being eroded by falling bond prices. So I'll keep you abreast of this situation if you're a fixed income investor, especially in the debt funds and liquid funds, and we'll keep our ears to the ground and take it up forward from here. Let's now come to the US dollar index, popularly known as the Dixie. The Dixie rose 0.51% on a week-on-week basis after rising on 3 out of 5 trading sessions last week. Emerging markets, including India, do not want a strong dollar, because that impacts our balance of payments, especially the imports, which become more expensive and therefore fuel inflation. Remember that crude oil and natural gas have risen along with the Dixie, and that is a negative which the markets have ignored completely in the euphoria of the budget. As the chart of the Dixie tells you on your screen, the index is basically attempting to rally higher from the downward sloping wedge, and therefore the higher it goes, the more pressure it will exert on bullion and emerging markets together. Now, there could be challenges for the Indian equity market bulls if the Dixie was to remain above the 91.50 level sustainably in the coming week. Last week, I advocated an estimated range between 91.70 on the upside and 89.5 on the downside, which held perfectly. The coming week is likely to see an estimated, I repeat the word estimated here, a range between 92.15 on the upside and 89.90 on the downside. Do keep watching this space absolutely carefully, because you're likely to receive volatility from here. Friends, let's now go to the Bank Nifty, which is the second most liquid counter on the NSE, and this index rallied on 5 out of 5 trading sessions, as you can see on your chart on your screen. This index gained 16.65% on a week-on-week basis, thereby outperforming the Nifty 50 by a huge margin. The Finance Minister's announcement on disinvestments of 2 PSU banks acted like a steroid shot for the index. Short covering was seen immediately, and the index rose by over 2,500 points on budget day alone, which was fueled by short covering by very surprised bears. Notice how the daily chart on the screen shows an inverted hammer, which means an upside down hammer. The body is small and the shadow or the wick of the candle is long and it is inverted, which means the price opened in the lower end of the intraday range. The bulls attempted to pull the markets higher, but encountered into selling resistance, and the closing was fairly close to the opening and in the lower end of the intraday range. That is a possible early warning that higher levels are likely to run into resistance. Now, how do you know that the bulls will seize control of the market? It's very simple actually. For the bulls to take charge completely, they must push and keep the price above Friday's high, which is at 36,615 levels in the spot segment. And in the alternate scenario, if the price was to slide lower as compared to Friday's intraday low of 35,545, it may trigger some selling. Now let's allow the market to tell us where it wants to go rather than try to second guess where it's going. The price activity on Monday onwards will tell you what is happening. The price for now remains above the 25-day exponential moving average, which means the overall trend still remains higher. And in the week before last, this index was at number 2 of the most volatile list. And last week also it remained at number 2 of the most volatile list. Hey, this is the data which I update every evening post-market on my social media pages. You can keep seeing how the indices or the individual stocks are moving up and down the gainers list, the losers list, most liquid, most volatile counters list. And last week I advocated a range between 32,050 on the upside and 29,000 on the downside, which was overcome on the upside. But I had warned you, being a budget week, this was quite likely. The coming week is likely to see an estimated, I stress on the word estimated here, estimated range between 37,575 on the upside and 33,725 on the downside. The volatility or the statistical beta still remains high. So there is a fair degree of probability that in the coming week also the ranges might just be overcome in either direction. But my reading of the situation is that the breach of these ranges will not be as big as it was in the budget week due to the obvious reasons. Friends, let's now go to the most liquid counter on the NSE, the Nifty 50. This index rose smartly by 9.46% on a week-on-week basis after rising on 5 out of 5 trading sessions, as you can see on your screen on the chart, but it underperformed the Bank Nifty because it's made up of 50 stocks and it's heavier compared to the 12 stock constituent Bank Nifty index. Now, here again, the rally in the Nifty was more of a relief rally. I'm coming to why in a bit. And the first thing that comes to your mind when you see the chart on your screen is that the candle size of 1st of February, the day of the budget, is fairly big. Remember, the Nifty rose more than 600 rupees on the budget day itself. But look at the candles made after the budget day. The candle size is shrinking, and although the market has opened with gaps, the bulls are unable to make the Nifty go significantly higher after a bullish opening. Also note the negative divergence which I have marked with the red arrows on your chart. In January, I warned you about a decline in the market based purely on the fact that the prices were rising, as you can see on the Nifty's price chart window, but the RSI in the lower window was falling. And sure enough, you saw a very swift, very steep corrective decline in the Nifty thereafter. And look at what's happened in the week gone by. The price has zoomed, but the RSI still remains low. So the negative divergence still remains, which is why I have basically titled this video in the thumbnail, Will the Markets Basically Correct in the Coming Week? This is not just clickbait. This is not just to entice you to watch the video, but this is a real threat that you will face. Now, the RSI over negative divergence over, you have to see the litmus test of the bulls will be in keeping the Nifty higher, as was the case with the Bank Nifty, above the Friday intraday high, which was at 15,015. Now that will show the markets that the bulls are still in command. Alternately, if the market remains below the Friday low at 14,865 levels, it may trigger another round of profit taking and you could see some bull unwinding. But the overall picture says that the uptrend, for now at least, still remains intact because the price is still trading above the 25-day exponential moving average. Now, in the week before last, the index was at number 6 on the most volatile list, and that situation remains unchanged. Last week, I advocated a range between 14,100 on the upside and 13,150 on the downside, which was exceeded on the upside. But then here again, I had warned you that it was the budget week and anything could happen, which it did. Now, the coming week might see an estimated. Here again, I strive on the word estimated. Range is likely between 15,500 on the upside and 14,350 on the downside. Here again, the volatility being high and the possibility of a technical correction being open, I think this range, the coming week's range, might also be breached in either direction. But like the Bank Nifty, I think the breach will be smaller rather than as large as it was last week. Now friends, the Nifty coverage over. I'm coming to the most popular segment of this video, wherein I tell you 5 stocks which are high beta, high impetus stocks, where you will take small exposure, wait for larger price moves to make your money, and 5 stocks which have a low beta and low impetus, where you will take large exposure and wait for smaller price moves to make your money. The attitude and aptitude of traders is different, therefore it could appeal to different types of traders. So the high beta, high impetus stocks where you take small exposure are Z Entertainment. Number 2 is SBI. Remember, it saw a huge move last week after it announced its numbers. Number 3 is Ultratech Semco. Number 4 is Shree Cements. This is the second cement company out here. Number 5 is Can Bank. What's common between Can Bank and SBI is that both are PSBs, public sector banks. Remember the finance minister's emphasis on disinvestment of PSU banks. Now let's come to the low beta, low impetus stocks, wherein you will take big exposure, wait for small moves. The number 1 is Bajaj Auto, number 2 Biocon, number 3 SBI Life, number 4 L&T Finance, and number 5 Gas Authority of India Limited. Do note that as the volatility rises, this list is susceptible to being reshuffled, and therefore the constituent stocks might just shuffle from the low beta to the high beta list next week also. You'll have to keep your guard extremely high in the coming week. Volatility and price swings are likely to be fairly high. Things can actually turn on a dime, my friends. So I urge you to trade on lower exposure and focus on capital preservation. Coming up on your screen are my contact coordinates. Like I told you, I would love it if you join me on my social media accounts. We'll have conversations going and analyze the market together at the end of the session, late evening every day. And I hope you like this video. If you do, please subscribe to my channel if you haven't already done so. Click on the bell icon to receive updates about fresh content being put up here in the comment section. I'm looking forward eagerly to hear from you about what you think of this video. Do help me reach out to fellow like-minded traders by referring my video to your family and friends. Thank you for watching my video. This is Vijay Bambani signing off for now. I wish you have a very, very profitable and lucrative week ahead. Bye-bye.